Guys, there are three massive reasons why most traders fail when they use the moving average indicator. And I guarantee you're probably making at least one of these mistakes right now. Reason number one, they think, hey, price is above the moving average, so we must be in an uptrend. It's time to buy. Nope, that's not always true. Markets don't live in straight lines. Price can still crash right after being above the line. Reason number two, they believe when price touches the moving average, that's the perfect time to buy or sell. Sounds simple, right? But in reality, it's not that easy. You need specific market conditions and confirmation before taking that trade, or you'll just get trapped in fake signals. And reason number three, this one is the most dangerous. They see two moving averages cross each other and instantly think, boom, that's my entry. Big mistake. In fact, this is one of the most common reasons traders blow their accounts. The crossover doesn't always mean a new trend is starting. Sometimes it's just noise before another reversal. So here's the truth. All three of these common beliefs lead to inconsistent results. But in this video, I'm going to show you three powerful tactics that completely changed the way we use moving averages, turning it from a weak, unreliable tool into one of the most accurate and profitable strategies in my entire trading system. So if you're serious about learning how to use the moving average the right way, smash that like button right now, hit subscribe if you haven't already, and get ready because this video might just flip the way you trade forever. Let's dive straight in because this first step is absolutely crucial. We're talking about using the moving average to identify the trend. Now, a lot of traders think, oh, the moving average is pointing up, so that must mean we're in an uptrend. But that's not always true, and that's exactly where so many traders get it wrong. Here's the truth. The moving average by itself won't tell you the real direction of the market. It's just a tool, and like every other indicator out there, it's completely based on one thing, price. And in trading, price is king. It's the heartbeat of the entire market. Every indicator you use, every setup you look at, all of it comes from price movement. So if you're only staring at the moving average line and ignoring what price is actually doing, you're basically trading blindfolded. The secret is this. You've got to combine the market structure with your moving average. That means looking at how price forms highs, lows, breakouts and pullbacks, and then using the moving average to confirm that structure. Because when you understand both the story that price is telling and how the moving average reacts to it, that's when everything starts to click. You'll start to see real trends, not just random lines on your chart. So tactic number one, and this is a big one, is to combine market structure with the moving average when identifying a trend. Do that. And suddenly your chart stops being confusing and starts telling you exactly what the market is doing. All right, guys, let's make this super easy to understand. Imagine we're standing right in front of a whiteboard. This blue line right here, that's our moving average. And this black line, that's the price itself, the heartbeat of the market. Now, you've probably seen this before, price bouncing up and down around the moving average, looking kind of messy, and then suddenly, boom, it shoots up. But here's the thing. Most beginner traders see price sitting above the moving average and instantly think, yup, that's an uptrend. Or if it's below, oh no, it's a downtrend. But that's way too simple. And honestly, that's one of the biggest mistakes that keeps new traders from making consistent profits like the pros. Because here's the truth. A moving average alone doesn't define a trend. It just reacts to price. The real secret is combining it with something powerful, market structure. You don't just look at lines on a chart. You've got to understand the story behind the movement. You wait until price starts forming higher highs and higher lows while staying above the moving average. That's when you can say, okay, this market is officially trending up. And that's your moment to start planning a smart, safe, high probability buy entry. And here's why this matters so much. If you skip the market structure part, you'll end up trapped in consolidation zones where price just bounces sideways doing absolutely nothing. And if you're trading a trend continuation strategy, entering during consolidation is basically often to lose money, not just small losses. I'm talking about draining your account kind of losses. So to protect yourself, you need a clear system that filters out that noise. That's why I use something I call the 1-2-3 move. It's simple, it's clean, and it's insanely effective. Step 1, price pushes up and creates a new high. Step 2, it pulls back slightly and forms a higher low. Step 3, it pushes again and forms a higher high. That's your confirmation. That's when you know, all right, this market is officially in an uptrend. So think of the moving average not as a magic signal that decides everything, but as your compass, a directional guide. When price is above it, that's your green light to look for buys. But your true confirmation comes from price structure itself, those higher highs and higher lows. When you combine both, you'll avoid getting crushed in sideways markets and start focusing only on strong trending setups that give you the best possible edge. And if you're wondering which moving average to use, my personal favourite is the 50 EMA. It's like the perfect balance. It's fast enough to catch early trend shifts, but not too sensitive that it throws false signals at you. Some traders prefer the 200 EMA for long-term trends. Others use the 20 EMA for short-term scalping. But me, the 50 EMA is my go-to weapon for trend identification. And of course, test it yourself. Find the one that fits your trading style, because mastering this concept could literally be the difference between being a frustrated beginner and a confident, consistent trader who actually understands the story behind every news in the market. All right, now that you've got the concept down from the whiteboard, it's time to hit the real charts. This is where theory meets the battlefield, guys. This is where we see how it actually looks when the market is moving live. Take a look at this chart. Seriously, zoom in, pay attention. You'll start to notice a pattern that happens all the time across different time frames. Price moves up, down, sideways, bouncing between zones, teasing traders. And most people jump in way too early thinking it's trending, when in reality, it's just consolidating. So here's the $1 million question. When does the market actually start trending? Hold that thought, because we're about to break it down step by step. Check this out. Price drops below the 50 EMA, and right here, this is where our detective work begins. What we're hunting for now is the legendary 1-2-3 move. If it's an uptrend, it flips the other way around. This pattern is our escape route from the deadly trap called consolidation. But here's the trick. If you look closely, the market hasn't formed a clear higher high and higher low yet. That tiny candle closing below the last low, too weak. That's not a real break. We need a clean, decisive push that clearly breaks the previous low to confirm a trend. Then it happens. Price moves down, bounces back, creates an equal low, climbs into a lower high, but still no real breakout. Then boom, it shoots up and closes above the previous high. That's the moment we can finally say, all right, this is an uptrend. Everything before just sideways noise, just the market warming up before the real show begins. Now imagine this. You jumped in early during that choppy consolidation, thinking it's a trend continuation setup. What happens? You get chopped out over and over, stop loss hit, frustration level maxed. That's what happens when you trade inside noise. But when you wait for price to confirm the trend, when you wait for that clean higher high or lower low, that's when your entries start to feel like precision strikes instead of random guesses. Now let's flip the script. Let's talk about a downtrend example. Take a look at this chart. Price touches the 50 EMA, starts moving sideways, bouncing up and down like it's confused. This is the market playing mind games. So when does the real bearish trend start? Right here, when price breaks below the 50 EMA and forms a lower high. In a downtrend, we're hunting for one high followed by a lower high, one low followed by a lower low, and boom. Once you see that pattern, that's confirmation. The market is now officially in a downtrend. Now here's where it gets exciting. When price is below the 50 EMA and structure confirms it, the odds of price continuing lower are way higher than it suddenly flipping bullish. Why? Because structure and moving average alignment are screaming. The sellers are in control. So if you see that setup, think like a pro. Don't fight the trend, ride it. Get ready for that sell setup, but only when the chart confirms it. And hey, if this all feels a bit too much to digest, here's a bonus tip, a simplified hack that still works insanely well. When price touches the 50 EMA, just draw two horizontal lines. One at the previous swing low and one at the previous swing high before that EMA touch. The zone between them, that's your consolidation zone. Price is just ranging there, no real trend yet. But once price breaks out of that zone, either above the swing high or below the swing low, boom, that's your trend confirmation. Oh, and one more pro tip. If you see wicks piercing through those levels, always adjust to the lowest or highest wick. That's your true boundary. Everything between those lines is noise. But once you see price break through decisively, that's when the magic happens. Look here, price breaks below the zone and bam, that's our official downtrend confirmation. This method gives you signals a bit faster. Sure, it's slightly less precise than the first approach, but it's super practical if you want something fast, visual, and easy to apply. By combining moving averages with market structure, you're not just reacting, you're anticipating the next move before most traders even notice it. So yeah, next time you open your chart, don't just stare at the EMA and guess. Read the story the market is telling you, because when you understand that story, that's when trading stops being random and starts becoming powerful. Alright guys, get ready because this next strategy is absolutely insane. We're talking about one of the most powerful concepts in trading, using the moving average as your area of value. Now here's something that almost nobody talks about on YouTube. Each market has its own favourite moving average. I know that sounds wild, but it's true. Every market, whether it's a currency pair, a stock, or even crypto, moves with its own rhythm. Some react better to faster moving averages, others to slower ones. And your mission as a trader is to figure out which moving average your market respects the most. Because once you find that, your accuracy skyrockets, your trades get cleaner, and your confidence goes through the roof. And don't worry, I've made it super easy for you. You don't need 100 different lines on your chart. Forget that. You only need 3 key EMAs, the 20 EMA, 50 EMA, and 100 EMA. That's it. These 3 are your ultimate secret weapons. If you know how to read them properly, they'll literally tell you when the price is ready to bounce, giving you prime opportunities to enter buy or sell positions at exactly the right time. When I say area of value, I mean that golden zone where price loves to react. It's like a dynamic support or resistance zone that moves with the market. You're not just looking at a random line, you're watching how the market respects that line. When price touches it and reacts, that's your signal that something big is about to happen. And to make sure you fully understand how this works, I'm going to show you 3 real chart examples. No theory, no fluff, just pure real-world setups that you can use right after watching this video. Oh, and if you want an even deeper dive into how to find the perfect moving average for each market, I've made a separate video all about that. The link's down below in the description, or I'll talk more about it at the end of this video. So stick around because once you see how this strategy works in action, you'll never look at moving averages the same way again, and your trading game will level up faster than ever before. Alright, buckle up because what I'm about to show you is going to blow your mind. Take a good look at this chart. Seriously, pay attention. See how the price keeps bouncing off the 50 EMA again and again? It's wild, right? You can literally see it acting like a barrier, sometimes a strong resistance, other times a solid support. That 50 EMA line? It's like an invisible wall the market actually respects. But now, let's flip the game. Let's swap that 50 EMA for a 20 EMA. Boom! Instantly, you can see the difference. The market just doesn't react the same way. It's almost like it doesn't care as much about the 20 EMA, but it respects the 50 EMA way more in this particular chart. And that right there is our clue. For this pair, the 50 EMA is the MVP. It gives us real repeatable reactions where price consistently bounces. But here's the thing, what works for this chart might not work for every other one. Every market, every pair has its own personality. Some love the 20 EMA, others follow the 100 EMA. And the only way to find out which one your chart respects the most is to test it yourself. And don't worry, I'll show you exactly how to do that by the end of this video. Now here's the simple version. Go back in time. Scroll through historical data and count how many times price actually bounces keenly off a specific moving average. That's how you discover which EMA works best for the market you're trading. But here's the catch. Don't just jump into a trade because price touches the line. That's how beginners blow accounts. You need confirmation, something that tells you the bounce is real. So what kind of confirmation? It could be a strong bullish candle after the touch, a candlestick pattern like a hammer or engulfing setup, or even a supportive structure you spot on a smaller time frame. Personally, those are my top 3 go-to confirmations before ever pulling the trigger on an EMA bounce trade. Now here's the real secret, the core of tactic number 2. Always use the moving average that fits your specific currency pair or market, not just any random EMA you saw someone mention online. The more accurately your EMA matches the market's rhythm, the sharper your edge becomes. And look, let's be real, this isn't some magic trick that makes you rich overnight, but once you know which EMA your pair actually respects, you're no longer guessing. You're trading with data, precision, and confidence. It's such a simple tweak, but it's insanely powerful when done right. And don't feel like you have to use the exact same EMA settings as I do. The goal is to test, analyze the channel, and find the number that your market truly reacts to. That's how you trade like a pro, not a gambler. Now get ready, because once you master this, your entire view of moving averages is about to change forever. Alright, listen up, because we're diving straight into the 3rd trading tactic, and trust me, this one is an absolute game changer. This setup right here, it's hands down my favourite strategy of all time when it comes to using moving averages. We're not just talking about lines on a chart, we're talking about using the moving average as a power zone, a real sweet spot where traders find the best buy or sell opportunities. But this 3rd tactic takes it to another level. This is the exact same setup I used in one of my most profitable trades, and it's all about waiting for the price to bounce right off the moving average, perfectly aligned with a key support or resistance zone that's been tested multiple times. Check this out. Price was pumping up strong, breaking above the 50 EMA, and then boom, it pulls back, dropping right into that 50 EMA zone. Now, that 50 EMA alone can already be considered an area of value, a spot where traders are watching like hawks. But here's where it gets exciting. The price didn't just touch the EMA, it also landed exactly on an old structure zone, one that used to act as resistance and later flipped into support. And not just once, it's been tested several times before. When you've got all of that lining up, a moving average touch, a strong support resistance zone, and a clear bounce, that's when you get one of the most accurate profitable trade setups you'll ever see. Why? Because at that exact spot, tons of traders are watching. Some are trading off the moving average, others off the structure level. And when both groups jump in at the same time, that's like rocket fuel for the market. The buying pressure stacks up and you get those powerful reversals that can send your trade flying into profit. And here's the key. Once you see that confirmation candle, that's your signal. That's your green light to take the shot. This is exactly how I entered this trade. Waited for an uptrend above the 50 EMA, waited for a pullback into the EMA, and made sure it aligned with a major support or resistance zone. That combination right there, moving average plus structure confirmation, is what I call a sniper setup. It's simple, but insanely effective. Now just look at how powerful this strategy becomes when you combine those 3 ingredients. The EMA trend, the structure zone, and the candle confirmation. It's like stacking the odds completely in your favour. And don't go anywhere, because next I'm going to show you a bearish version of this exact same setup. You'll see how it works in reverse and why it's just as powerful when the market starts to drop. Alright guys, check this out, because what I'm about to show you is super important. We're looking at this chart right now, and I want you to pay close attention. When we combine market structure with a moving average, what are we actually looking for? It's simple. We want to find a level that's been tested multiple times in the past. Why? Why? Because when price keeps bouncing off the same zone again and again, it's screaming, hey, this is a major area where the market reacts. And if you look to the left side of this chart, you'll see exactly that. A strong structure zone that's already proven itself over and over again. Now, once we've identified that key structure level, the next step is to combine it with, you guessed it, the moving average touch. So we've got two powerful ingredients here, the EMA, which shows us the direction of the trend, and the area value, which used to be strong support and now might flip into resistance. When those two things line up, oh man, that's where the magic happens. And then look what happens next. Price comes right up and touches the EMA. That's the market saying resistance confirmed. But it doesn't stop there. A shooting star candle forms right at that level, giving us a crystal clear signal of selling pressure building up. This is the kind of setup that gets me hyped because it's where everything aligns perfectly. The trend is bearish below the 20 EMA. The market structure supports a reversal and the candlestick gives you confirmation. Now check out the pattern here. Price moves in a clean 1, 2, 3 formation. First push down, a small pullback, and then a stronger push lower. We're seeing lower highs and lower lows, textbook signs of a strong downtrend. Then price pulls back right into that sweet spot, the old support that's now acting as resistance, exactly where the 20 EMA sits. When that shooting star candle appears right there, that's not a coincidence. That's a signal flashing in your face zone. This is your trade setup. If I were taking this trade, I'd enter right around that zone with a 1-3 risk to reward ratio because that's my go-to sweet spot for profit targets. And what happens next? Exactly what we expected. Price drops hard, bouncing straight off that zone, proving just how powerful it is when you combine structure, moving averages, and candlestick confirmation all together. That's why I keep saying when all these factors line up, it's not just another trade. It's a high probability setup that can literally shift the way you see the market forever. All right, guys, this is it. The moment you've been waiting for, because in the next few minutes, I'm going to show you the most accurate way to find the perfect EMA period. The secret that can boost your trading accuracy up to 80%. Now, listen carefully. The exponential moving average, or EMA, is hands down one of the simplest yet most powerful tools in trading. It's like a radar for price movement. It helps you spot the trend, identify potential reversals, and know exactly where the market is heading. But here's the catch. The EMA only works like magic if you're using the right period. And that's the part most traders completely mess up. So how do you find the perfect EMA period for your chart? The answer is surprisingly simple and insanely effective. You've got to watch how the market reacts to your EMA line. Seriously, that's it. If price keeps bouncing perfectly from the EMA, respecting it again and again, boom! That's your golden setting. That's your market's sweet spot. But here's the twist. There's no one-size-fits-all answer. You can't just copy some random setting from the internet and expect it to work everywhere. Every market, every time frame has its own rhythm. Let's break it down with this example. First, we test the 20-period EMA and watch how price reacts. Does it respect the line or slice through it? Then we move to 30 EMA, then 50 EMA, 75, 100, 150, and finally 200 EMA. Each time, we're looking for that clean, consistent reaction, that bounce that tells us the market actually cares about that line. After running through this test, we discovered something amazing. This market reacts beautifully to the 200 EMA for long-term trend analysis and to the 50 EMA for short-term trades. That means for this chart, 200 EMA gives us the big picture trend, while 50 EMA helps us catch short-term entries and exits with precision. But remember, this setup might not work the same in every market or time frame. If you switch to another pair or a different time frame, you've got to run the same test again. Observe, compare, and find which EMA the price actually respects. That's how professionals do it. You're not guessing, you're collecting data, analysing patterns, and building a strategy that fits your market perfectly. So, if you want to level up your trading and stop relying on random settings, this is where you start. Go back, test your EMAs, find the one your market respects the most, and use that as your trend foundation. It's simple, it's smart, and it's insanely powerful when done right. And hey, if you want to see me break this down in even more detail with live examples and chart analysis, check out the video linked in the description. I go step by step, so you can master this once and for all. This is one of the most important foundations every serious trader must understand, because once you get this right, everything else just clicks. I'll see you in the next video. Let's go!